It has been pulled from the ground for 6,000 years. It cannot be eaten. It cannot shelter anyone. It has powered more wars, more empires, and more financial collapses than any other element on Earth. And as of this year, a single ounce of it costs more than most people on the planet earn in a month. The story begins in Lydia. Around 550 BC, a king named Croesus did something no ruler had done before. He minted coins of pure gold and stamped them with a lion. He gave them a fixed weight. He put them into circulation. Before Croesus, gold was decoration. After Croesus, gold was money. The idea spread across the ancient Mediterranean in a generation. Persia adopted it. Greece adopted it. Rome built an empire on it. The metal that had once sat in tombs and temples now moved through markets, armies, and tax ledgers. It became the thing people trusted when they trusted nothing else. For more than 2,000 years, that trust held. Empires rose and fell, but gold remained the standard by which wealth was measured, stored, and fought over. Spain looted it from the Americas in the 16th century and flooded Europe with so much of it that prices doubled in 100 years. Britain pegged its currency to it in 1821, creating the classical gold standard, and for nearly a century, the international monetary system turned on a single promise. Paper money could be exchanged for a fixed amount of gold, and every government that joined the system staked its credibility on honoring that exchange. By the late 1800s, Germany, France, and the United States had all tied their currencies to gold. World trade ran on the assumption that the metal under the vaults matched the notes in people's hands. The system was elegant. It was also fragile. Then the world broke it. The First World War forced governments to print money far beyond what their gold reserves could support. The classical gold standard collapsed. Countries tried to rebuild it in the 1920s. It collapsed again. The Great Depression hit. Banks failed by the thousands. And in April 1933, President Franklin Roosevelt signed Executive Order 6102, one of the most extraordinary economic decrees in American history. It forbade private citizens from hoarding gold coin, bullion, or certificates. Americans were required to surrender their gold to the Federal Reserve by May 1, 1933, in exchange for $20.67 per ounce. Refusal carried a penalty of up to $10,000 or 10 years in prison. Roosevelt's government then revalued gold to $35 an ounce under the Gold Reserve Act of 1934, effectively devaluing the dollar by 40% overnight. The citizens who had turned in their gold at $20.67 watched the government reprice it at $35. The profit funded a new stabilization fund. The public had no recourse. The system that emerged after the Second World War was supposed to prevent that kind of chaos. In July 1944, delegates from 44 nations gathered at a hotel in Bretton Woods, New Hampshire, and designed a new monetary order. The U.S. dollar would be pegged to gold at $35 an ounce. Every other major currency would be pegged to the dollar. The architect of the American side was Harry Dexter White, a Treasury official who believed the dollar should sit at the center of the global economy. His British counterpart, John Maynard Keynes, wanted something different. A new international currency not tied to any single nation. White won. The dollar became the world's reserve currency, backed by the largest gold stockpile ever assembled. Fort Knox held over 20,000 metric tons. The system worked for a generation. Other countries could exchange their dollars for American gold at any time. The promise was absolute, but the promise had a weakness nobody in that New Hampshire hotel room fully understood. Throughout the 1950s and 1960s, the United States spent aggressively. On the Marshall Plan, on military bases ringing the Soviet Union, on the war in Vietnam. Dollars poured overseas. Foreign governments accumulated them, and slowly the math stopped working. There were more dollars circulating abroad than there was gold in American vaults to redeem them. France, under Charles de Gaulle, began demanding gold for its dollars. Other nations followed. The U.S. gold reserve shrank year after year. By 1971, the United States held roughly 10,000 metric tons of gold, half of what it had held at the system's peak, and the volume of dollars held by foreign governments was several times larger than the gold available to cover them. On August 13, 1971, Richard Nixon convened a secret meeting at Camp David. His Treasury Secretary, John Connally, and Budget Director George Shultz were there. The Secretary of State was not invited. Neither was Henry Kissinger. For 2 days they debated options. On the evening of August 15, Nixon went on television. He announced that the United States would suspend the convertibility of the dollar into gold. He called it temporary. He framed it as an attack on speculators. The speech lasted 18 minutes. It ended a monetary system that had governed global trade for 27 years. The gold window closed. It never reopened. Inside the agency, they had a different word for it. Traders and economists called it the Nixon shock. Foreign governments were blindsided. The Smithsonian Agreement of December 1971 tried to hold things together with a new set of fixed exchange rates. It lasted 15 months. By March 1973, the major economies had abandoned fixed rates altogether. Currencies floated, gold floated, and the price began to climb. In 1971, gold was $35 an ounce. By 1974, it had passed $180. By January 1980, as inflation ravaged the American economy and revolution engulfed Iran, gold hit $665 an ounce. Adjusted for inflation, that 1980 peak would hold as the real record for more than 4 decades. Then the price collapsed. Paul Volcker's Federal Reserve raised interest rates to punishing levels, squeezed inflation out of the economy, and made dollars attractive again. Gold sank. By 1999, it had fallen to $253 an ounce. Central banks around the world were selling their reserves. The metal that had defined money for millennia looked, for a moment, like a relic that was 1 ounce. By the end of the next crisis, it was the most wanted asset on Earth. The 2008 financial crisis sent gold surging again. Investors fled stocks, fled banks, fled everything except the one thing that could not default. Gold rose from $730 in October 2008 to over $1,300 by late 2010. The European sovereign debt crisis pushed it higher. In August 2011, it touched $1,825. Quantitative easing by the Federal Reserve, trillions of dollars created from nothing, made the case for gold feel urgent. Then the Fed began to taper. The dollar strengthened. Gold dropped 29% in 2013 alone, nearly half of that loss crammed into 2 days in April. The crash was violent. Investors who had believed gold could only go up discovered that it behaves, in the end, like every other market. It can fall as fast as it climbs, but the metal was not finished. COVID-19 sent it past $2,000 for the first time in the summer of 2020. The pandemic locked down economies. Governments printed money on a scale that dwarfed the 2008 response. And gold did what it has always done in moments of fear. It absorbed the demand. Then came the years that rewrote the record books. Central banks in emerging economies, China, Russia, Turkey, India, Poland, began buying gold in volumes not seen in decades. In 2024 alone, central banks collectively purchased over 1,000 metric tons. The reasons were not sentimental. They were strategic. After Western nations froze Russia's foreign currency reserves following the invasion of Ukraine, every central bank on Earth recalculated the risk of holding assets denominated in someone else's currency. Gold cannot be frozen. Gold cannot be sanctioned. Gold does not require another country's permission to exist. The price responded. Gold closed 2024 above $2,500 an ounce, a 27% annual gain. In 2025, it shattered $3,000, then $3,500. In January 2026, it reached an all-time high above $5,600 per ounce. As of this week, it trades around $4,300. The total gold ever mined in human history stands at roughly 220,000 metric tons. All of it, every ring, every bar, every coin, pulled from every mine across 6,000 years, would fit inside a cube measuring roughly 22 meters on each side. One cube, valued at more than $15 trillion. Central banks now hold roughly 40,000 tons, about 20% of all the gold that exists. The United States remains the largest single holder, with over 8,000 tons locked in vaults at Fort Knox and the New York Federal Reserve. Gold accounts for about 17% of all global foreign reserves, and that share is climbing. The regulation that Roosevelt's order triggered would reshape not just American monetary policy, but the entire architecture of how nations store trust. 3,000 miles away, and 90 years later, Central banks are still making the same bet. The metal outlasted every currency ever pegged to it. The price was $5,600. In 1933, it was $20.